Good morning. This is AC222H, Managerial Accounting. This lecture is the first lecture of the class, covering Chapter 2, and it is to replace the class that we missed, or that was canceled due to the storm last week. This is the content that was or would have been included in that class. I'm going to put a note up to ask you to watch this video before you come to class on Tuesday. On Tuesday, we'll move into the problems from Chapter 2. So I want to introduce the concepts here in this video. So let's get right to it. You remember that in our introduction class, we talked about financial accounting versus managerial accounting and the number of differences between the two disciplines. The result of that was that managerial accounting is going to be much more internal focused. It's going to deal much more with information that's either real-time or current or projections into the future. As opposed to financial, which was all about getting transactions recorded, summarized, and reported in financial statements. One of the things that we mentioned at the end of the last class was that costs were going to be the primary driver of decision information inside of companies, and so managerial accounting and the concepts that we're going to learn in this class are going to be really focused more on cost than anything else, because those are the items that companies have the most control over. So today, Chapter 2 is really an introduction to the different ways that a company can look at costs and how costs are used in analysis to determine whether the company is being run appropriately, efficiently, and profitably. So let's get right into it. Before we start to talk about costs, I want to kind of set up for you what you can expect to hear us talk about during the course of this semester. And all of the analyses that we talk about are going to be based on company models. So we're not going to really talk at all about sole proprietorships or individual entrepreneur type issues. We're going to be talking about issues from a company's perspective, right? If that's the case, then what types of companies might these analyses and methodologies that we're going to cover, what types of companies might these apply to? Well, these are the types of companies that we're going to be talking about one way or another during the course of this semester. So we really have three business sectors that we're going to focus on during the course of the term. You can see that service companies, merchandising companies, manufacturing companies. So when we talk about service companies, we're talking about companies that don't have a tangible product, right? They're not producing a hard good, something you can touch and feel. Service companies provide intangible services, things that are mostly intellectual property, or that deal with expertise that's applied to a given area, but not, not something that can be built or manufactured. Some of the largest service organizations are accountants and lawyers. You can see here healthcare, insurance, banking, consulting, really anything, again, where we need a specific type of expertise being applied to a certain problem or fact pattern. So service companies in the United States actually make up the largest sector of our economy. There are far more service providers of all sorts than there are manufacturers or merchandisers. And service providers can run the gamut from individual accountants or lawyers or doctors to practices, full staffed practices, and very large companies like health companies, banks, or insurance companies. So we're kind of all over the lot. The one thing we know for sure about these companies is they don't typically have any type of inventory because they're not delivering a manufactured product. The next type of company that we'll be dealing with along the way here are merchandising companies. Merchandising companies are companies that deal with manufacturers, but they don't actually manufacture a product themselves. So merchandising companies can either sell manufacturers' products to other businesses or sell manufacturers' products to end users. If a company sells to other businesses, they're typically called a wholesaler. So they're going to buy generally larger quantities from a manufacturer, and they'll turn around and sell in smaller quantities to other businesses. And in some cases, the businesses that they sell to then turn around and sell to end users. In some cases, manufacturers will sell directly to the company who is going to sell directly to the end users without going through a wholesaler. Either way, the company that ultimately sells the product to the end user, they are retailers. And of course, very simple examples of retailers, very big ones everybody knows about and sees. Walmart and Best Buy are listed here, but Amazon is probably the largest retailer at this point with respect to transactional activity. So these companies have one thing in common. They don't manufacture a product. That is, they don't make a product from scratch. But they do carry a substantial amount of products in inventory. And that's because that is really their purpose. Their purpose is to be the supplier between the manufacturer and the end user. So why do we need these? Why don't manufacturers just sell directly to end users? Well, in most cases, it's because manufacturers are set up to manufacture. That's their business. Their business is to create whatever product it is that they specialize in. Their business is not to then provide that product to hundreds of thousands or maybe millions of end users. That's another whole level of complexity and really another whole specialty that most manufacturers don't want to be involved with. Most manufacturers want to manufacture and they want to sell in fairly large quantity. They don't want to sell one at a time, and they don't want to deal with a million different customers. They want to deal with a manageable number of customers who will move large quantities or purchase large quantities of their product. So merchandising companies are very important in the structure because they fit that category of space between manufacturers and end users. With respect to managerial accounting and the analysis that we do, merchandisers will play a key role in many of these analyses, will easily apply to merchandisers. Service companies really primarily have labor to deal with. And so while we can and we will apply some of the concepts that we learn about to the service company environment as well, I say there are fewer methodologies and analyses that make sense for service companies because their cost structure is less complex than merchandisers or certainly manufacturers. But from a management accounting standpoint, there is no type of business that is more complex and requires more analysis than manufacturing companies. And that's because manufacturing companies do have the entire life span of a product that they're dealing with, right? So not only do they have labor to deal with, but they also have plant and facilities to deal with. They need equipment. And these companies, manufacturing companies, because they're turning raw materials into something completely different when they finish their product, their cost structure is more complex. All of manufacturers have significant levels of inventory. Inventory is an area where lots of cost is generated. Because of the nature of the way a manufacturer works, their inventory is typically separated into 3 categories. All right, we have the raw materials that we need to actually begin to transform to create the finished good, whatever the finished good is. At any given point in time, we have goods that are in the process of being completed but not completed yet. That level of inventory, what we have in process, is called work in process inventory. And finally, once we've completed the transformation of the raw material into a good that we can sell, we have items in finished goods inventory. The transformation process is a process where we combine labor and the raw materials to create, transform, convert those raw materials into a finished product. You can see the example they're using here is Toyota, but I'm sure you can think of lots of manufacturing examples. Again, in the United States economy at this point, manufacturing is not the largest sector, but it certainly does account for a lot of the gross domestic product and a lot of the activity, economic activity that takes place in the country. Management accounting and the concepts, methodologies, and analyses that we're going to talk about in this class really grew up out of the manufacturing sector. And that's why it is primarily and predominantly applied in manufacturing environments. Because these companies are so complex and because the costs that they generate cover so many different areas, it became critically important very early in the industrial age for companies to really understand their cost structure better. And that was kind of the beginning of accountants beginning to look at data in a different way, not just to produce a report of the company's overall financial health, but to produce reports that would actually be useful in assisting management in the operations of the business to achieve a certain goal. And so most of what we deal with in this class for the rest of this semester is going to be primarily focused on manufacturing companies. But these concepts and analytics that we'll talk about, they definitely do cross over to merchandising and service companies. And in some cases, we'll do examples where the company in the example is a service company or a merchandiser, just to make sure that it's clear that these concepts cross over. But because they were born in the manufacturing arena, more of what we do will be there. So those are the 3 types of companies we'll be talking about as we move through the concepts in this class. All right, so when management thinks about cost, they think about cost differently than financial accounting defines cost. For financial accounting, costs really end up in 2 primary areas, and we'll go over those in a second just to kind of remind us of what we learned in 221. But they really have to do with categorizing costs to reflect in the financial statements. Well, in the actual operation of a business, costs are generated and managed over a much wider group of considerations or actions, and that wider methodology, that wider span, is something called the value chain. So the value chain is the way a company is going to look at the costs that they incur compared to the value that is generated amongst all of their business operations, not just those operations related to the production of a product, right? So the example you see on the screen right now is the full picture related to the value chain of a company. And that value chain really starts with an idea. Before a company is producing a product, before they can build anything, somebody has to have an idea. That idea is usually generated either by a need that's developed in the marketplace, a problem that's been identified that needs to be solved, or a unique approach to providing a solution to an issue that hasn't really been defined yet. You need very forward-thinking individuals to be dealing with producing a product where there hasn't been either a problem identified or an issue related to a need that's been identified. But that certainly does happen. If you think about Steve Jobs and Apple with the iPhone. When Steve Jobs created the iPhone, there was not a clamoring amongst the population saying, we really need a little mini computer that we can hold in our hands that will let us research and communicate with each other and talk no matter where we are, or allow us to play music or entertainment or any of the things that the phone actually does, right? There was no ready market. There was not this outcry that said we really need this. But as being a visionary as he was, he realized that if you can create something that drives demand, that is practical, useful, and convenient, you could actually show people that it's something that they needed when they didn't even think they needed it, right? So not all R&D is that way. Most R&D is, again, based on either filling a need that's been identified that's not being adequately met, or solving a problem. But in any case, the R&D phase is the first phase of a company's value chain, and that's where sort of the initial spark comes from. Once we've identified an idea and we've done a little due diligence and we think, okay, this idea has some legs. Either there's already a demand that we could fill and right now it's not being met, or we can do a better job of meeting it. Then we move to the design phase. And the design phase is really taking the idea off of paper and turning it into a prototype, turning it into an actual tangible item. In that process, we learn some things about what's practical, right? And what's going to be possible to replicate many times over with the quality that we need it to be at a price, at a cost level where we could sell it and earn a markup and meet the need in the marketplace, right? Will individuals understand the value of the product that we're delivering? Can we produce it in a way that the value proposition, that is the cost, does not outweigh the reward? Once the design phase is complete, and companies can come back to design a number of times, because design is not only creating something, sometimes it's reimagining something. Sometimes we've already created something and now we go back and say, maybe we could do this better. So back to design. If we redesign this, if we change the production line, if we move things around, if we change the steps in the production process, can that make things more efficient? Can we produce higher quality for lower cost? So design happens again initially when an idea is moving from the sort of the initial spark to the prototype, but it's also a place companies will go back to when we have something that's working, but we check periodically to make sure that there's not a better way, or that things haven't developed, technology hasn't changed, we haven't just gotten smarter, so that we can now go back and redesign the way this product should be approached. All right, so we get through the design phase, and then we're into the area that most people think about when they think about cost, right? And that's production. So in the production area, now we're talking about material, labor, and overhead. We're talking about the three basic areas of cost that are also areas of inventory for manufacturers. This is where we actually accumulate the raw material, where we apply our expertise and technology, and we transform or convert that raw material into a finished good. If we're a service company, this is where we apply our intellectual property, our skills, our unique training to produce the result that our customers need. We design a building, we litigate a case, we do tax planning or prepare tax returns, right? Whatever it might be. So this is kind of the area where the conversion takes place. Or if we're a merchandiser, this is the purchasing area, where we go and find the supplier for the good that we want to sell and then bring those goods in-house. The next item on the value chain is marketing. Now, marketing, while it's listed sequentially after production, marketing really begins at the same time that production begins. If you're a company that's making a product, the last thing you want to do is spend all of the effort and money to create a product and then have that product sit on a shelf while your salespeople then go out and try to find buyers, right? Because every minute that product sits on the shelf, it runs the risk of aging and becoming obsolete. Some things will become obsolete quicker than others, but either way, as time moves on, we don't want things to age. A product has its most value early in its life cycle, right? So marketing, while it's listed sequentially after production, really should start at the same time that production starts, so that by the time we're finished producing the item, by the time that item is ready to go to finished goods, we already have demand built up for it. We already have customers. We're ready to ship it directly to either our wholesaler or the retailer, whoever's going to be the end user. Right. So marketing is an expense that includes advertising, it includes sales, right? Everything that it takes to find customers for your business. Next on the list is distribution, and this is a really important expense for a lot of reasons. Distribution can be a killer for companies. If their manufacturing facilities are not located proximally to their customers, then the cost of moving the good from the manufactured location to the end user becomes a significant cost. And so companies will spend a lot of time trying to be sure that they're being efficient about where their product is and how quickly they can get it to their customers. Some companies will set up warehouses so that they have a main manufacturing facility someplace, but they have warehouses scattered geographically closer to their end users, and they'll keep their finished goods inventory in those warehouses so that when they need to ship to a retailer or to an end user, those warehouses are closer than the main manufacturing facilities. Think about automakers. European and Japanese automakers have plants in the United States. They didn't always have plants here, but they do now. Why do they have plants here? Well, mostly because it's tremendously expensive to build a product in the Far East, in China or in Japan, put it on boats, sail across the Pacific all the way to the west coast of the United States, and then put it on trucks and move it from the west coast all the way to the east coast of the United States, right? Ridiculously expensive. To service North America, if your manufacturing facilities are outside of North America, distribution can be ridiculously expensive. It can be a time lag. It can be driven or at least affected by a lot of things, including weather. So, these companies looked at their costs and realized, for what it's costing us to ship items over here, we could set up a local factory, make the product right here. We already know what the process is. We'll just replicate the process that we use in our main factories, make the product locally, and then our shipping will be dramatically reduced because we're only moving hundreds of miles, and we can do that very easily without dealing with ships and without dealing with weather issues. We can be much closer to our end users, especially because the product that's sold into the United States is not exactly the same as the product that they sell elsewhere in the world. That's a very big company and a very big example, but the truth is any size company needs to understand what their distribution expenses are and take them into account. Look at Amazon. When Amazon started operations, every Amazon delivery was being made either through the United States Postal Service, UPS, or FedEx, right? Now, Amazon has a huge fleet of their own delivery vehicles. In addition to that, they hire third-party independent contractors who pick up at an Amazon warehouse distribution center and deliver packages to your home. Why? Because Amazon realized that distribution was one of their largest costs. And they didn't have any control over that cost. They were at the mercy of Postal Service, UPS, and FedEx rates. And those companies had other customers as well. So they couldn't always or wouldn't always prioritize Amazon's business without charging them a significant amount. So Amazon said, there's an opportunity for us to keep that in-house and manage it better. And so they chose to build their own distribution network. A huge cost and a huge item that companies need to consider. And finally, the last cost on the value chain, and maybe one that companies, especially new companies, don't spend enough time thinking about, is customer service. Customer service is really the support of your product after it's in the end user's hand. And there's nothing worse as an end user than to call a company's customer service line and either get somebody who can't answer your question, doesn't understand the product or its application, or can't get you to a person who is knowledgeable, right? And all of that is because companies tend to underestimate the amount of labor, the amount of manpower they're going to need to provide the level of customer service that's required in order for their customers to be satisfied and their reputation to stay intact. So another cost that companies are more and more aware of in the value chain is customer service. And while it's shown as the last cost on the value chain, it is definitely not the least important cost in the chain. All right, so that's how, from a management accounting standpoint, when management thinks about costs, they're thinking about costs over all of this chain, right? They're thinking about how costs apply in each of these categories, not just the GAAP methodology for accounting for costs. And we'll talk more about that in a minute. All right. So we're going to get into now the different methodologies, the different approaches to analyzing cost, how we can define cost differently, and how companies will look at cost differently. And when we do that, what's changing primarily is the cost object. That is the lens that the company is looking through, the perspective that the company is taking when it's considering the cost that it's trying to analyze. So you can see from the slide that a company's cost object or perspective can be very different. In this case, the text in the slide is using Toyota as our example. So if you are a manager inside of Toyota, you could analyze costs in a number of different ways. You could want to know what the cost of building an individual car might be. Just give me the total cost to produce a Toyota Camry from start to finish. What is the total cost structure of producing that car? How many raw materials do I need? How many skilled laborers do I need? How long does it take to move through? What automated tools and equipment do I need? What is the cost of the process from beginning to end? That is going to help me understand how I need to price this car in the marketplace in order to earn the markup that I need to make my business profitable, right? That is for someone in the company who's responsible for the pricing and the profit on each individual unit. However, if you're someone in the company who is a little higher in the chain and you're responsible for utilizing the company's plant assets effectively, you might want to understand what the cost is to build each different model. You have plants located all over the world. You have models being produced in those plants based on the machinery, the equipment, and the production line capabilities in each of those plants. So you might want to know what are the production line costs, what are the total production costs of producing Toyota Tundra trucks versus producing Toyota Corollas, and which one of those do I sell more, which one of those do I have a better markup on, which one of those do I have a better market for. By understanding the cost to produce an entire model, I can look at my total model lineup and try and decide, do I keep all of these? Am I making enough markup on all of these? Can I redeploy some resources from one model to another, from a model where the demand is pretty low or the markup is pretty low to one where the demand is higher and the markup is higher, and therefore more efficiently use my company's resources? So if that's the case, then I want to know about the costs of an entire model line, right? And what goes into that. I'm going to look at costs a little bit differently than just looking at the cost of completing one particular unit of that model, right? So you can see here, cost objects can change and the perspective can change based on who inside the company is looking at the information and what decision you want the data that you're getting to help you make. All right, so when we start to analyze costs, when we start to define costs, it's going to be critically important that we understand the perspective through which we're trying to decide how to analyze and what this analysis is going to tell us. Right? So the lens, the perspective that a company uses when they're analyzing costs is called the cost object. All right, so now we get into the first distinguishing features of costs, or the first definitions of costs, the first way that a company might look at costs differently. And these two are very basic items, and they're categorizations that we will use over and over again in this class. So, and that is the difference between direct and indirect costs. So direct costs are going to be those costs that can be traced directly to the object, whatever the object is. So if we're talking about, for instance, the cost of building a Toyota Camry, then direct costs are those costs that go directly into the product. Things like the tires, the windshields, the steering wheels, the upholstery, the seats inside, the engine itself, the door panels, all of the individual items whose costs can readily be connected to each individual unit, right? If the cost object is the complete model line, then direct costs will be any cost related to producing that model, including the factory and the plant and any specific items that might be included in that. So direct costs are costs that you can easily trace directly to the end product. Indirect costs then are those costs that are necessary to produce the product, but that we can't trace to each and every one of the products, right? So let's say that we have that production line producing Toyota Camrys. Well, we also have a supervisor for that line who makes sure that the materials are on the line when they're supposed to be there, that the labor that we need is in place and they're working the right hours, that the skill sets that they have are the skills that we need in order to complete the task. Right? They keep the line running. So they are critically important to the process of producing the car, but you can't see the benefit of their work in each and every unit. You can't point to it. You can't put your hand on it. There is no direct trace between that supervisor's role and the actual car that's produced. So his cost, her cost, their cost is what we would call an indirect cost. It's something that we have to incur that's going to benefit the entire process, but that can't be traced directly to the end product, right? So all manufacturers will have direct and indirect costs that they need to consider in their analyses, and we will take those into account when we're determining what costs are important to us. Total cost, then, the concept of total cost is going to consider all of the direct and indirect costs, including anything that's incurred throughout the value chain. That's what management internally is going to consider total cost to be. It's all the resources that are used to create, produce, sell, distribute, and support the products. Total costs are all of those. Some of those may be direct, some of those may be indirect, but all of them are important when it comes to managing the overall cost structure. All right, so this is kind of where we step back for a second and take a look at how costs were generally looked at under the gap scenario. When we were looking at costs in financial accounting, we're looking at costs basically with respect to how we were going to ultimately report them to investors and creditors. So any costs that related to a product whether they were direct or indirect didn't matter. All product costs were looked at as costs that were included in inventory initially and then moved to expense or cost of goods sold when the products that we created were actually sold. If we were generating costs that didn't have to do with the product, then all of those costs were considered operating expenses or selling and administrative expenses. Those costs are what we called period costs. They would typically show up on the income statement. They were never on the balance sheet. They went directly to the income statement, right? And they were simply categorized that way so that they could be reported in a format that matched whatever GAAP required. So in the GAAP world, all the formats related to financial statement reporting, it was either a balance sheet or an income statement item, and these are the way costs were looked at. For management accounting, we don't have this reporting framework to have to deal with. So we're looking at costs in a much more holistic way. While there may still be costs related to the operations and the overhead and costs related to the product itself, we don't necessarily get hung up on defining the cost based on where it's going to be reported, right? We just look at the costs across the entire value chain. All right. When management starts to break costs down, there's a number of ways that they might do it. And the first of those is by taking the costs that we consider direct costs, costs that we can trace directly to the product. There are two categories of those, direct materials and direct labor. If we put those two direct costs together, we typically call those prime costs. Prime because they're primary, because they are easily traced to the product that we're trying to produce. So putting the two direct costs together, direct materials and direct labor, is known as prime costs. If you see that phrase anyplace, that's what it's referring to. On the other hand, if we want to look at production costs where we don't take into account the direct materials, because we know that the materials themselves are direct and that they're going to go to each and every product, what we really want to know is how much does it cost us to convert those raw materials into the good that we ultimately sell. Then we put together direct labor and this other category of indirect costs called manufacturing overhead. These two categories combined are the cost to convert a product from raw materials to the good that we ultimately sell, the finished good. So manufacturing overhead and direct labor combined, they are what are called conversion costs. So we have prime and conversion. All right, the next distinction is the distinction between costs that are under management's control and costs that are not, right? So when management is analyzing costs, they need to take into account everything. They need to make sure that they're planning for all costs. But the costs that are most important to them are going to be those costs that they have some control over. If they could fluctuate the cost, if they could increase or decrease the cost because they have control over that particular cost, that's going to be a cost that they're going to spend more time reviewing because that's where they have some flexibility. Uncontrollable costs are costs that they can't change, and while they still need to make sure they're taking them into account, that they're not forgetting them or not planning for them appropriately, they'll spend a little less time analyzing them because they don't have the ability to make a change to those costs. So An example of an uncontrollable cost might be something like lease or rent expense. Generally, when a company signs a lease, the lease payment is then locked in for a period of time, sometimes as short as a year, sometimes as long as 10 or 15 years. Either way, once the lease itself is signed, there's not really much that the company can do to change that cost, right? They could break the lease, but that's going to have its own implication and its own cost. So once it's signed, at least in the short term, there's really nothing that a company can do about that cost. Another uncontrollable cost would be property taxes, right? Property taxes are assessed by the county or municipality where a company's facilities are located. So the property taxes are based on an assessment of the property that the locality or governmental agency does, and then that assessment is multiplied by a tax rate, right? The tax rate, again, set by the governmental entity or municipality. So there really is nothing that the company itself can do to change that cost, right? I mean, they might be able to argue that the assessment is too high. They might be able to try to bargain for a lower rate because of the size of the complex. But at the end of the day, the tax is the tax is the tax, and there's nothing they can really do to manage around it. They can't lower that tax by not using part of their building, right? It doesn't matter. The town will say the building is this big. For a building that big, this is the value. For that value, this is the tax rate we apply, and this is the amount of tax you owe. So every business has both controllable and uncontrollable costs, and while management needs to make sure that they plan for all costs, they will spend more time analyzing costs that they can control. Kind of going along with that, when management is faced with limited resources, and all management are faced with limited resources, they have to make decisions about where they're going to spend their money. And so they're going to look at different options. If we go back to Toyota, Toyota has a fixed amount of money to spend based on what they're projecting their revenues to be. So with that money, they need to strategically place plants. They need to buy equipment. At the end of the day, what they need to do is produce product that's going to sell, right? So at one point or another, they're going to have options in the way that they spend their money. Do we put a plant in the U.S.? Do we put one in Mexico? Do we build a plant that's capable of producing Camrys and Corollas, or do we build a plant that's capable of producing RAV4s and Tundras? Right? There's going to be options, and someone in the company is going to have to make a decision about which of those options they choose, because they don't have the ability to choose all options. Well, when they're making that choice, they're going to look at an analysis of the different costs involved in those different choices, right? When they do those analyses, the only thing that they want to look at in those analyses are those costs that are going to be different under each of the different scenarios, right? Costs that are going to be the same under all of the scenarios, they don't need to look at, and they will not look at, right? If the cost is not going to change no matter what decision I make, then I don't really care about it. It's not something that I need to think about. Yes, it's a cost that I have to plan for, but it's not a cost that's relevant to the decision that I'm trying to make, right? So when a company distinguishes between costs that are going to be different under the different options that they're looking at, and those costs that are not going to change no matter which option they choose, they call those distinctions relevant and irrelevant. So costs that are going to change based on the alternative that we're looking at, those are relevant costs. Those are the things that I want to know about. Those are the things that I want to analyze. Those are the areas where I have some decisions to make. On the other hand, if costs are not going to change, if the lease expense is going to be the lease expense no matter what product I build in that particular facility, if the tax expense is going to be exactly the same no matter whether I place the facility in Tennessee or in Kentucky, then I don't really need to look at that cost. It doesn't matter to me. It's irrelevant, right? So when companies are trying to determine how they want to analyze cost, depending on what it is they're analyzing, they're going to look to see what costs are important, which ones are going to change based on the alternatives I have, which ones are not. Sometimes costs become irrelevant simply because we don't have the ability to change them. It's not that they would not be different under the different scenarios. It's that we don't have the ability to change them because we have committed to something, right? So one of those things, one of those types of costs might be those lease expenses. For instance, let's go back to Toyota again, right? The square footage that they need in their buildings to produce Tundras and RAV4s is larger than the square footage that they need to produce Camrys and Corollas because those vehicles are larger. The lines that those vehicles utilize take up more space. So they might be looking at a plant saying, okay, we have a choice here. We could build Tundras and RAV4s, or we can build Camrys and Corollas. Well, if we're going to build Tundras and RAV4s, we need 100,000 square feet of space. If we're going to build Camrys and Corollas, we only need 75,000 square feet. Well, the problem is we already have built the building, and the building is 100,000 square feet. There's nothing that we can do now. We can't just move everything into 75,000, turn off the lights in the other 25,000, and tell the landlord, whoever it is, that we're just not going to use that area over there. It's just going to sit idle. So we don't want to pay the lease on that. You know, the landlord's going to say, sorry, the whole building's yours. You control the space. Whether or not you utilize it is up to you. But the cost itself is not going to change, right? That lease expense then becomes a sunk cost. It's one that we've committed to, that we can't change. Maybe if we were building Camrys and Corollas to start with, we wouldn't have built a facility quite this big. It doesn't matter now. So even though we don't need that much space, and the people who are pitching Camry and Corolla might want to take into account the lower cost, the fact is that lease cost is a sunk cost and is irrelevant, right? So just because we've committed to it, we can't change it. That makes it a sunk cost, and sunk costs are irrelevant. All right, so relevant and irrelevant. These distinctions come into play when the company is trying to make a decision between different alternatives. All right, the last two categories of cost that are critically important that a company will always utilize, and we will come back to fixed and variable is the other, over and over again in the course of this semester. So the first of these two is fixed. All right, so this chart shows how fixed costs actually work in the context of a company. So what this chart is showing us is the cost to insure an automobile for a year. And what it's trying to show us is that the premium for insuring that automobile is $1,788 for the year. Now, it doesn't matter whether the company starts up the vehicle and pulls it out of their parking lot or drives the vehicle 10,000 miles, because miles is not a driver of this particular cost, right? If you want insurance coverage for the vehicle, the insurance coverage for that vehicle is going to cost you $1,788. And it doesn't matter if you don't ever start the vehicle up for the year or if you drive that thing 10,000 miles, the cost is going to be the same. No matter how many miles you drive, the cost of the insurance premium is fixed at $1,788. It doesn't get higher the more miles you drive. On the other hand, if you don't drive at all, it still costs $1,788. And that is the hallmark of a fixed cost. It's a cost that does not change over different activity levels. Okay? That's a fixed cost. Now, on the other hand, we could have a variable cost. A variable cost works in exactly the opposite way. A variable cost is something that moves in tandem with the change in activity. So, the more of something that you do or produce, the higher the cost. The less of something that you do or produce, the lower the cost. On this chart, we still have miles as the activity here, but this time the cost that we're measuring against it is the cost of a gallon of gasoline, or actually the total cost of gasoline for the year. So, if we have that same truck and we never pull it out of the lot and we never start it up, we drive no miles at all with that truck, then the cost of gasoline will be nothing. We're not utilizing any gas because we haven't moved the vehicle. However, as soon as we start to move it, for every single mile we drive, the cost of the gasoline for the year is going to rise. The more miles we drive, the more money we're going to spend, because the more gallons of gasoline we're going to use. The fewer miles we drive, the less we spend. In theory, variable costs are controllable costs because we decide how many miles we're going to drive, right? If we don't want the increased cost, then we don't drive 10,000 miles. We cap our driving at 5,000. Either way, the hallmark of variable costs is that they change in total in direct proportion to the changes in volume. Now, it's important that you understand that while the total cost changes, the cost per gallon of gasoline is not changing here, right? So again, the lens that we're looking through makes a difference. Variable costs change in total because we're using more of that item as the activity increases. But the cost of the item itself that we're using, that does not change the more miles we drive. The cost of the gallon of gasoline has nothing to do with the miles that we're driving. So the cost of a gallon of gasoline is going to be the same for every single mile. What changes is the amount of usage of that gasoline. So for every gallon that we utilize, we spend the same amount, but when you total up the number of gallons we utilize more as we drive more, right? And that is also the basic rule for variable costs. They change in total, but they do not change on a per unit basis. That's different than fixed costs. Fixed costs do not change in total. They're constant in total. But if we looked at the fixed cost of auto insurance based on a mileage count, the fixed cost per mile for 1,000 miles is going to be much higher than the fixed cost per mile if we're driving 10,000 miles. That's because the total cost doesn't change. So if we're spreading that total cost over more miles, then the fixed cost per mile is lower. If we're spreading that same total cost over fewer miles, then the fixed cost per mile will be higher. All right. So again, those relationships are critically important. Fixed costs are constant in total, but change per unit. Variable costs are constant per unit, but change in total. All right. So we have direct and indirect. We have relevant and irrelevant. We have controllable and uncontrollable. And now we have fixed and variable. 8 different ways to look at costs so far, and we're only in the first chapter. These concepts are going to come back to us over and over again. And the 4 here that we're going to spend the most time with for the entire semester are going to be direct and indirect and fixed and variable. So spend a little bit of extra time being certain that you understand those concepts. All right. That's all that we're going to cover for this first lecture. When we get together for class this coming Tuesday, we will be doing problems from this chapter 2 to apply these concepts in a problem scenario. As always, if you have any questions or anything is not clear, please shoot me an email or meet with me during my office hours, and I'll do my best to clarify these items. Thanks, and we'll see you on Tuesday.